Welcome to the Insider In-Depth podcast. Today we're going to be looking at management buyouts and succession policies. We're going to find out how you make your deal a success, how sometimes they go wrong, and how you can get the best for both the buyer and the seller in a deal. Hello, I'm Kurt Jacobs, the editor of Insider magazine, and welcome to our latest Insider In-Depth podcast. Today it's been sponsored by BSN. And today we're going to be looking at the issues of management buyouts and succession policies. Why do they work? Why do they fail? And perhaps why you should consider doing one. And around the table, I've got three experts who are going to help us look at how we can get these things away properly. So I have Paul Batchelor from Knights.
Hi.
I've got Gareth Jones from Virgin Money.
Hi.
And not least, I've got Pippa Miller-Hawkes from BSN.
Hello.
Let's start with an opening one. If we could start with you, Paul. Let's say something simple. Why do management buyouts in the first place? Why not just hand it over to the biggest corporate who comes along and offers you wads of cash?
I suppose lots of people have different agendas and different reasons, and if it's a life's work, they want to either ensure that it carries on, or they've got family in the business, or they actually have got people that have worked with them that they treat like family. So they might want to actually ensure that they have a good place to go to afterwards. A lot of it is to realise that for a pension. So some people will definitely go, well, I want to sell when I'm 55, which has got nothing to do with the business. It's just their age. So it's actually about, there are a number of different reasons why people would want to do an MBO or sale. Obviously selling to trade, you might get a bigger price, but it might lose half the workforce. So there's always the pros and cons of both.
I think it's about selling to someone who understands your business as well, because I think a lot of times I've seen sales to external buyers where they acquire a great business and then think, I don't really understand it, I don't know what to do with it. Whereas an MBO allows it to remain independent, people can carry the legacy of the business on, and often your team have got some of the best ideas about what could happen with the business to take it to the next level. So I think if it's backed as well by a bank helping them with the funding to grow, there's some great stories out there.
Yeah, look, I think it's different deals, isn't it? Sometimes trade is right and there'll be a perfect partner and execution will be really good and the future will be bright and the vendor's happy. But I think there is a higher execution risk with that
That's
than
true.
if you've thought about a management buyout, you've been planning it for a while, the management team are ready, the smoother succession of the business. I think it's a model that works for that.
Some people never want to sell. Some people say, I'll carry on doing it forever, but age gets the better of them, or their other half wants to retire, all those types of things. Some people just want to make sure that the business carries on and the thing that they've built continues. Some people don't like the idea of selling to someone else, but other people just want to have had enough of it and want to get a big check and go on a cruise.
You've got Fred, who's owned this business for 40 odd years. And he's got Dave, who's 20 years younger than him, but came in as a recruit and so forth. And what feels bad about handing Dave over to some sort of large faceless corporate?
Definitely. I've seen some really successful examples in our client base where they're on their sort of fourth generation management buyout. And it's a great story. And every MBO that happens, a few more people join the shareholder pool, because as the business grows, you've got more people in different positions that are absolutely fundamental to the operations. And actually it means that business can thrive and become, a real expert in its field, rather than almost selling out to a bigger player who can't be as agile or concentrate on the things that have made that business so unique in the first place.
Yeah, so loyalty, I think, is a big part. These management teams, running business, not easy, is it? They've been through a lot together. So I think that counts for something. But the vendor also mentioned before, lifetime's work. There's one opportunity to get this right in terms of the transaction. So loyalty on its own isn't enough.
A lot of these business owners, and in fact the team's taking over, it's the first and only time they will ever do this. And they are frankly clueless. They've seen the words, letters MBO and gone, I know vaguely what it means. But they come to you either A, unprepared, or perhaps with unrealistic expectations.
I think a lot of the times I see it, the business owner's got no idea what the business is worth, and they don't know how it would be funded. They think, well, my management team can't afford it, and I don't know how they would make the structure happen. And so a lot of the initial questions that I get asked are, how do I value my business? How would it be structured? My employees don't want to put their houses on the line for this transaction because the risk appetite perhaps is low at the moment.
If I look at our portfolio at the moment, what we're steadily seeing is the average age of the owners is getting older and older. Running the businesses is, I think, getting harder and harder with a lot of matters that are in the economy. So actually, they're so focused on delivering the business today that the sale and what happens next almost comes, if you're not careful, as an afterthought. And I think that bit around starting your succession plan as early as you can, getting the management team involved as early as you can is really key to making it successful. But again, if I look at our portfolio, I'd say a lot of those business owners today aren't sure of what the exit would be.
No.
A lot of owner-managed businesses assume that they know how to do everything. So they've got lots of people who actually can do it, and the business survives when they go on holiday and things like that. But most of the time, they're surprised when actually you are replaceable. And the best businesses and the ones that get the best multiples are actually where the shareholders aren't crucial to the business. So it's that early stage planning part is not necessarily knowing what the exit is, but it's actually, if you can make yourself redundant, and yes, you're still involved, yes, you're still there, but then the value is in the business, and then you've got more backable management team as well.
I think one good thing I've seen is where owners are sharing financial information, strategic information to the management team. It really empowers them then. When they come to do an MBO, they're on top of their numbers. So when the bank are asking them, cash flows and what's your cost, what's your break-even point, it's really great to see a management team that know those numbers inside out.
Pippa, I think it goes beyond the numbers as well,
Yeah.
because the vendor passing on key information about customer relationships, supplier relationships, managing the staff. Yes, as a bank, we will interrogate people around numbers, but actually the quality of the management team or the new management team is probably the key thing that we're trying to assess when we're looking at a management buyer.
So that's really important, that. So it's more than just sort of, right, okay, I go through the spreadsheets, they seem to make sense.
Yeah, absolutely. Change of ownership transactions, history tells us a bit higher risk, and why the higher risk, generally it's been that the new teams aren't as strong as the old team. So really understanding the mix of skills, making sure that you can really see the buy-in of the management team going forward, making an assessment of management competence, strategic planning.
How does a sort of vendor-assisted deal work? And sort of, in simple terms, I mean, you're not just going to Cal saying, "Can I have the cash, please?" To most people, it seems almost nonsensical. I'm selling the company, so I'm putting cash into the deal. How does it work?
So essentially, they'd be rolling over an element of the price in the form of some deferred consideration, which is paid over a period of time, or they might leave some equity in. I've seen that before, where they might leave 20% equity in to say, I'm backing you, management team. I think it's going to grow again, and so I'll support that, and hopefully they have another exit event in the future. But most commonly, I'd say it's deferred consideration or loan notes, which normally have to rank behind the bank if a bank's funded as well. We'll say that. But that's right, because if the bank has cashed out a large proportion of the price on day one, it's only fair then that should be dealt with first. And if there's spare excess money in effect, the vendor loan notes can get repaid And they can have security over those loan notes as well, can't they? So
Yeah, they can do. And look, the loan notes tend to be the balancing item. So you agree a price on day one, sort of based on a multiple of the earnings of the company. There might be a stake from incoming management, but that's not usually huge. The bank will look,
They call it hurt money, isn't it, basically?
yeah, sort of skin in the game, I guess. But the bank will then do a portion of debt, again, as a multiple of earnings, but will be a lower multiple than what you've paid for the business.
And I think the way to incentivize that management team, if they haven't got, yes, it's important to have some skin in the game, but is to pay down that debt as quickly as possible, which everyone wants to do. And that's because then that drives value into their equity. So if they actually don't really pay a huge amount for their equity stake, but they realize that actually if we grow the business, if we actually get to the point where we've paid Gareth back, we're all sorted, then suddenly all that value is then in their shares.
What are the real deal killers when it comes to you? What are the things that you find again and again, you think, oh no, that's really messed this up?
I think back to Gareth's couple of points, really, price expectation of both parties. So it's meant, everyone always says to me, oh, it's a friendly deal. And I think it is until we talk about price. But obviously the vendor wants to maximise their one-time event of exiting the business, and the management team want to buy as cheaply as they can in order to, arbitrage what they're buying. But I think ultimately it's got to be a fair price. As Paul's alluded to, it might not be as high as you might get from a trade buyer, but then you've got less due diligence to go through. You have got a team that know what they're buying and can do something very good with it, probably. And so as long as you're making sure the maths adds up, basically, and that the bank, if they're funding it, can be repaid sensibly with a buffer in case we have another pandemic or something along those lines, and the vendor can get what they want and the management team can afford it over a reasonable period of time, so they can pay it down in 5 to 7 years, I usually use as a guide. They know that after they've worked hard, it's theirs.
Yeah.
But trouble is that, I mean, let's be honest, I suspect when you're dealing with a lot of managers, you're dealing with some pretty big egos, and they're thinking, 40 years work here, and you're offering me how much? There's a sort of, I've had a chat with my mate down the golf club, and he got this for his business.
Or they've Googled a multiple, or they said, yeah, this is how much it's worth. And sometimes people have made up a number that's based on, I mean, what they should do is actually work out how much money they need.
Yeah.
Do proper modelling and actually go, well, in order to deliver this transaction, or rather to be comfortable for the rest of my life, this is the number. So that's got no relation to the value of the business, but at least they can actually say, right, this is actually the number that I'm happy with. And then when Pippa comes back and says, well, I've got one that's 2 or 3 million more than that, suddenly actually it looks like a good deal.
Yeah.
But sometimes things like the vendor's age, and sometimes they're sort of, well, I need to get £1 million, £2 million, £10 million. The magic number, which has got no relation to the value of the business, that can sort of wag the tail, as well.
Yeah, I think that valuation is obviously it's an art, not a science. It's unique to every business. Every business has got a set of circumstances. Kurt, back to your horror stories. There's probably 2 elements for me. One is if there's too much debt, particularly at the beginning, that
You've still viewed from a banker.
You've put too much strain on the business. Once there's a bump in the road, you're starting to get off course. And the second one would be these transactions are really time consuming. They can be distracting to put in place. And I've seen circumstances where, as the transaction's been going through, people have taken their eye off the ball and actually spent more time doing the transaction than running the business. And actually, when you come out the other side, the business isn't as good as
Like we get
they thought
really,
it was going to
really
be.
excited about the
Yeah.
deal. Let's do this. Let's do
Or it
that.
drags on, yeah.
Yeah.
Yeah, and it drags on. So, how do you avoid that? I suppose it's getting really good advice around the team for vendor and for management, actually, and getting that as
And
early as
probably appointing someone within the company who'll be the point person for the management team. I've seen that work really well. So they're almost become the spokesperson for the management team, and they'll deal with reviewing the legal documents and sort of negotiating some of the points.
Definitely need a seller's representative if you've got
Yeah.
multiple shareholders, and that works well because then some people can actually carry on running the business.
Yeah.
Whereas the person who is probably more suited to do that will then lead the negotiations. You've got to bring them along and actually advise them at the right time. But generally, if there's a trusted management team, then it works.
Well, flipping it, we're talking about valuations. We'll come back to horror stories in a moment. Do you get the management team undervaluing business because they can see where all the dirty linen is and sort of, well, they may think it's that much, but I know we've got a problem with that client and, we've got that outstanding issue here, which we rather would go away, but doesn't.
Realistically, it's actually just that if someone says that, is actually getting the good advice, independent advice sometimes, rather than a lot of advisors will have the accountants that will work with them and the trusted advisors from when they were in 1980, for example. And that happens quite often. And in that situation, that's when you've got to sort of challenge those people to go, right, these people will be integral to the transaction because they know the business inside out, and they'll also be integral to the management team afterwards because they'll still be there and they'll still want to get paid. But sometimes they're not qualified to do a deal and understand a deal or deal with completion accounts. Or actually, one of the horror stories I was going to talk about earlier was people not realizing what happens with the money in the business. It's when you sort of say something is on a cash-free, debt-free basis with a normalized level of working capital that gets thrown around all the time. But there's so much detail as to what cash is and what debt is and what a normalized level of working capital is. And you can save huge amounts of money by actually having someone who knows what they're talking about.
And also making sure you leave the business as a going concern with enough cash to carry on business as usual and achieve what it wants to do and make sure it can meet banking covenants, etc.
It's a big part of what we look at. Yeah, clearly you look at the transaction and make sure that that's right. But when we're looking at the forecast, the business as usual funding, whether it's for working capital, what's the capital expenditure requirement going to be as you go forward?
Yeah.
Some of these things don't get considered because there's so much focus on let's get the deal done.
Yeah.
But you've got to make sure the business is in good shape going forward.
I mean,
Often the vendors want to make sure of that as well because it's their pride and joy. It might be their name above the door. So they don't want suppliers not to get paid or the staff not to get paid the month after you've announced the transaction. And I think that's where good advice comes in, making sure you've modelled that, the working capital requirement of the business, what items are coming up that are due. And that's all good advice that maybe people aren't used to giving on a day-to-day basis.
there's that fear that vendors have, which is sort of, they got out and they basically let us sink afterwards. But, they looked after themselves.
There's that ego point of actually, of course it went down because I wasn't there type thing. And we've seen it a number of times where businesses have done that when people have bought them back and they've gone again and they've gone again with the same business. But I think Pippa's right in that actually, if people have built something, they want to see it go to a good home. They're not betting the farm every time. So whenever there's a investment decision in a business, if that's your sole asset, you're not going to be as bullish as you would do saying, well, actually, I'm the one who's going to risk it. I might be delayed and might be being paid out, but actually I think the business could then grow significantly because of that. And I've seen the vendors recently who have actually sort of taken a deal largely so that they are de-risked, that the family is sorted. And then they can go and have fun. They can do all those things. They can do all the things that they wanted to do. Not being overtly risky, but more sort of you're not betting the farm every time you make a decision. And they're the ones that really just grow significantly because people
I'd
can really
agree.
do the things they always wanted to do.
That's a really good point to bring up, which is sort of the relationship between the vendor and seller, well, afterwards, as it were. Let's suppose they've still got some skin in the game, and they've got the courtesy title of either chair or consultant, whatever. What's the tendency to sort of the new management to sort of, right, we don't want you here, just go away, enjoy, go on a cruise, and we'll give you a ring if needs be. Or the chair, or our chair or the exec, basically selling up on Friday, coming in Monday morning and still lording it around.
Yeah.
Yeah. Well, this is my office. I mean, how do you manage that?
I mean, it's another war story about
Go on.
a long time ago. I had that where we did an MBO, and then exactly that happened. The vendor sort of came in, and they sort of gave him an office and all those types of things. And the actual reality was he hadn't told his wife that he'd sold the business.
Brilliant.
So he, he's now, because he's now having to go and tell why he's not at work all the time. But actually, it was damaging to the business. They had to actually decide, right, and be quite forceful with him, saying, right, you're only supposed to be in 1 day a month or 1 day a week or all those types of things, and actually force them to do that. Generally, if you've got that type of person and they're not adding value, you just, for their own sake, you would say, right, actually it's time for you to go on that cruise.
That's part of the planning, isn't it? Because I think if you've had those conversations before the transaction, it's very clear what the role, if you can clearly define what the role is you want from that individual. I mean, BSN, we did our own MBO back in 2019, and actually having Steve, the outgoing vendor, was really supportive. I would phone him up and say, I'm thinking about doing this. Did you ever try doing that? What would your advice be? We took some decisions to sort of redevelop the property for our office, and he was very supportive of that. Delayed some loan note repayments to facilitate that because he could see it needed doing and it would benefit the business. So I think when you get that good relationship, sort of parent-child relationship, it can work really, really well. And you get the best of both worlds because he was happy he didn't have to come in every day anymore, and he could go and enjoy time with his family and travel and do all these amazing things. But at the same time, he was always there for it. He still is now, and he's not a director or shareholder anymore, but it's great. He's like my dad, He's like, but I think that lovely relationship can exist, and it's supportive, isn't it?
I think Pippa, that's a great example. Must help you advising people, having been through it yourself.
Absolutely.
I think there's a big continuum, isn't there? If nothing changes, it's probably not right. And if everything changes, it's probably not right.
Yeah.
Each team have got to find the balance somewhere in the middle that's the right circumstances for them.
Can I come back to something we talked about earlier? Because I think it's really important to raise it. Is this issue of the post-deal plan? Everybody gets so obsessed with the transaction. You're staying up till 2 o'clock in the morning. Let's break out the champagne and the pizzas because it's been done. You've been there.
Yeah.
Yeah. But how often do people sort of like, okay, go get subs almost fixated about it? It's a poor analogy, but the thing is, couples who get obsessed about the wedding but don't think about marriage, as it were. And it's that sort of relationship. Well, how is this going to work afterwards? Don't know. We haven't really thought about it yet.
I think it is a definite risk, and I've seen it happen where teams have run out of money on week one, and you just think, oh my goodness, who was thinking about this stuff? But I think always have a 100-day plan for the first few months, just to know, have you thought about everything? And that's where, again, the supportive relationship from the outgoing vendor is crucial. You almost need to sit them down and say, right, what do you worry about? What keeps you awake at night? Can I have your little black book of contacts?
It will have been a big part of the financial plan, will have been a big part of the analysis. And I guess we tend to look at the assumptions that's drawn on. And if you get a plan that shows year 1, year 2, sort of business is just going to go through the roof and doesn't show any reality to what's going before. I guess inevitably when we're looking at that, we're going to kick the tires pretty hard on the risks.
A lot of my clients don't realise is if they are having bank funding, you'll want some due diligence performed on forecasts, the business plan, and probably the management team themselves. And that's sometimes a massive shock to people, but the amounts of money that are being borrowed by the business.
That must be shock, though. You'll need cash in there, but also sort of the management team, how dare you have the temerity to question our competence and so forth?
There won't be shortcuts on it because we're talking with big sums of money, and
if it's done well,
it's got to make sure it's right.
If it's done well, it can be helpful, can't it? Because if the financial due diligence did flag up an area of concern for the management team buying in, that can be addressed and resolved before the transaction. So
I think the planning, though, goes beyond the financials. I was going to say the financials are always dealt with, but actually the operations of, for your customers, for your suppliers, for your people, they shouldn't be feeling a big change in this, really. And so actually that smooth transition between vendors and new management with suppliers, customers, that's, to me, that's really, really important.
I see that as one of the key value points of doing an MBO, that the continuity is there. Customers will feel that, the staff team will feel that. And I think if it's communicated well, people I see are often happy that there is a plan because they know Fred or Frederica's pushing towards 70 and they're probably thinking, who's going to run this business when they get to 75 and start having health problems? And so actually to say, great news, we're doing this MBO, business as usual. In fact, you've got now a young, energetic management team that have got some new ideas for the future, but with the support of the history of the business, it can be very powerful.
We've been talking largely about the business owner disappearing. So sometimes they will cash out, but they'll go again in 3 years' time. So they'll actually still be there. So actually getting those people to understand that it's no longer their business, but someone wants them to treat it like their business and to continue to grow it like their business. That's a transition that people who've never had someone saying, I need you to feed into this board report, or I need you to do this, or banks going, where's your financial MI, and all those types of things that yes, they've always had, but they've sort of self-regulated. Actually reminding those people, and so I've had that relatively recently, where you've got to tell people what, actually, this is your, as in, yes, you're still having to work, but you've got to remind yourself that you've de-risked it, and de-risked, that sort of remind themselves of the conversation that we had before of actually, you can now go have fun. What people want you to do is go have fun. Along the way, you're going to have to play the game, and you're going to have to report to people at board. You're going to have to report to banks. You're going to have to do all those things. But if you have a concern with that, that's when you just got to get on your banking app and just have a look at your investments or look at your bank account.
Talking relationships, let me pick on something that you probably feel strongly about, Paul, which is with buyouts and succession. Let's call the lawyer in at the last moment. Because let's be honest, you're an expense rather than is that often the perception?
It is actually, but it's not generally, it's not the truth. But you do have a perception of, right, okay, I'm only going to get the lawyers involved, or I'm only going to answer due diligence questions when I have to. And they're one of those things which are intensely frustrating because you're then immediately fighting fire. So if you've gone through a process where you've got a deal, you've signed heads of terms, everyone's doing it, and then you get delivered a 60-page due diligence questionnaire, and they're asking lots of questions, all of them the same questions, slightly differently phrased, but very, very sort of questioning or being interrogated about the business. Most of the answers are there, but because they haven't prepared for it or they're not ready for it, they take a long time to provide the information because they're also running the business. Usually people spend a lot of time saying, yeah, we're just putting all these things in place, but actually if you demonstrate straight away that you are well organized, you've got good governance in place, that can actually improve the idea of a multiple in a process situation. Similarly, if you've agreed a deal value, it can protect value and that value erosion of actually,
I think also where we work quite well together is we'll bring each other in on the deal as soon as possible, because there's things I've thought about the commercial financial things, but there's legal positions or concepts that might support the commercials of the deal that I don't know of, that becoming market practice. So Paul and the Knights team are really good at sort of saying, well, actually, if the vendor's worried about security, we could introduce a golden share where if they default on a payment, they can buy back in. And that adds a lot of value before we've even agreed heads of terms.
But what it also really helps is just the execution sort of risk on it, because there's a road to navigate. Again, each deal's going to have to go through that. And I think if you've done the work early and you've got good people sort of helping you navigate through that, you'll get through the traffic jams easier.
Well, as well, to get the bank funding, there'll be investment committees that need to approve it, and they'll need to be comfortable with the transaction, won't they? And actually, the ones I've seen that have been successful, all the what's ifs and buts have been thought through before it goes to those stages. And then, there's no surprises then, and it doesn't suddenly change at the last minute because we haven't thought about something, and therefore you have to.
Or I hope you wouldn't notice that bit.
Yeah.
Our investment committees don't tend to like last minute surprises, but a big part of that is down to our team having the experience to sort of having been through a lot of these transactions, that you sort of, when you're doing the preparation, we shouldn't be putting things to our investment committee that we're not totally satisfied on ourselves.
But that's why it's good to get you in at the start as well, as a joined up team, isn't it? And I'll often float things past you. What do you think about this? And you say, well, that wouldn't work, but this will work for us. Or
I think exploring
parameters of what you've got.
Exploring options is really good. I think when a plan comes and it can only be one way and it's this way or highlight that, these transactions are usually a bit more complex than that. So I think early on, keeping different options open and then honing in when everyone's agreed this is the right way to go.
And the danger of a failed process, no one really thinks about that because if you haven't thought about something and you can't get the bank funding, it's almost like when you're looking on Rightmove and you see that house has been off. There must have been something else to that house. Yeah, it must be because it's come back on, gone back off. And it might be completely different circumstances why that's happened. But if you've got something that failed to get away 5 years ago, there's a reason, and people fill in the gaps. And actually, it's always dangerous to sort of to go too far down, say that we didn't, because people will start to then think, well, there's a problem with the business or the people involved or the management team. So
there is something I'd like to bring in. I think we're heading towards him, but there is an issue I'd like to bring up before we do, which is EOTs. And perhaps it would help if one of you explained in layman's terms what an EOT is and why this has become so popular.
Sort of say, I think we're all looking up there.
Yeah, so an employee-owned trust transaction is, in a way, similar to an MBO, but you set up a trust for the benefit of all the employees, and that's the crucial bit. So the trust then buys the business from the outgoing shareholders, but all employees participate in the trust structure. And the reason it has become more popular is if it's done properly, along with HMRC guidance, then it can be capital gains exempt as a transaction.
And you say no CGT?
No CGT. But there are certain rules which I won't bore everyone with on this podcast. Get your tax advisors to have a look at it. But they are great. I think they work in certain circumstances. I think, as with anything, if the tax is wagging the commercial transaction, then you're not doing it for the right reasons. But I mean, we've worked on a couple together where they've been really successful. I think it suits small teams where they're highly professional, skilled, industries where perhaps it won't work because there's no key management running the business. Everyone's sort of equal.
So it's almost like a partnership
Yeah.
in effect.
Professional services, architects' practices, accountants.
I think we discussed it earlier. It's not necessarily the last resort, but sometimes it will end up being, well, we've not got anyone that wants to buy it, and that might be that it's not worth buying, but it might actually be that the type of the business is inextricably linked to the people. So therefore, if once they go, so it's quite a good way for those people who wouldn't necessarily be able to have an exit to facilitate some exit. I think it creates some complication on what happens if the business grows and someone wants to buy it, because you've then got very complicated ways of reversing out it. It's possible, and we're seeing more of them recently. And also, it's a very good way of retaining and incentivizing people. Because actually, if they've got a slice of the business, and they actually participate in the success of the business, the thing you've got to make sure that you make clear to those people is they also have the downside.
Is it important to say as well, Paul, from a legal perspective, the trust needs to have trustees that represent the best interests of all the employees, and ideally you need to have independent people doing that. So you would have an employee representative, you'd have an independent trustee, and then I think while you've got a large amount of deferred consideration or loan notes, the outgoing vendor can also be a trustee.
Back to Paul, what you were saying, things have failed before, and actually sort of almost you've tried everything else. They don't tend to get any sort of traction. Neither do the ones which are purely for a tax, for a tax play. But if there's been some serious thinking around succession through the whole people team, I think they can be really sort of powerful. Though as part of the process is an independent valuation of the business, which is something a bit different to a management buyout. But we tend to find leverage levels are a little bit less than a management than we do through a management buyout.
It would be interesting to see how those businesses grow or actually flourish down the line. So 5 years out, once the vendors are out, because there isn't necessarily as much of an ownership. Is there someone who's incentivized to grow the business? Do they sort of peter out after the vendors have gone? That's always a danger that we'll only know through sort of the reflection of time.
I'm going to wrap up again with a quick fire round. I'm going to start with you, Paul, then work around and finish with you, Pippa, which is basically a parting thought. It's a plea, a prediction, a promise, a warning, whatever. There's one thing you would like. Let's say it's either an owner or a manager who's thinking go through succession or an MBO. What's the one pearl of wisdom that you'd give them?
Obviously, get the good advisors, but actually think about those advisors. So in particular, if you're selling a business, actually think there are lots of people who will say, I'll sell your business, and they're agents. They just put the for sale sign up and wait for their fee. They're not going to necessarily deliver a deal. So it's actually thinking about the right people to get involved with. But also, if you're in the trenches with someone, you want someone to be able to go into bat with. You want someone to be able to throw under the bus. If you want to blame Pippa or blame Paul.
Look, right across the Midlands, got fantastic businesses that have been built up over a long period of time. I think smooth transition of those to continue being strong in the future is absolutely key. I don't think you can be too early in starting to think and plan, particularly if you're trying to bring a management team through with you. But I'd go back to the point before, through that process, please don't take the eye off the ball in terms of the quality of the business. Just make sure you maintain that, and that comes back to having good people around you that can take the transaction through smoothly. And Pippa?
Mine sort of enhances all of those points, I think, and it's have a plan. Even if you're a startup, have a plan, and don't be scared to bring good people into your business that can help deliver that plan, and trust them. have that trust and build that trust with them, because then an exit when you're ready, for whatever reason, will be so much easier. But if you're flying the ship on your own, it's a lonely place and it's a lot harder. So.
Well, thank you very much. That was a really interesting discussion, a really important subject. Thank you for BSN for sponsoring this event. Thank you very much for joining us, and hopefully I'll see you all again soon. Join us next time for more great conversation. If you want to take part in one of our podcasts, please get in touch.